Picture this. It is late, the room is quiet, and a chart glows on your screen. Then a red candle drops like an elevator. A friend writes, "Someone big is selling again." You tap the name and your stomach flips. It is the same contrarian who warned before the last storm. The investor who looked early, looked wrong, and then looked right when the floor vanished. That name is Michael Burry, and he has just sold another large block of United States stocks. He moved out while the rally looked strong. When someone who called the 2008 crash exits during strength, you pay attention. His short made him about $100 million personally, and over $700 million for his investors, as indexes sank in months. He knows how calm markets can hide sharp edges. But why did he do this? And what can you do? Stay until the end to find out a step-by-step strategy. We can track his moves because big managers must file public forms called 13F. They are delayed by a quarter, so you never have a live feed, but they show direction. Across his recent filings, Burry has been cutting United States exposure and adding targeted positions elsewhere. He exited 14 American names worth more than $70 million, even selling stakes in giants like Amazon and Alphabet while they were still strong. Why walk away from winners? Start with price. The price-to-earnings ratio is like a speedometer for cost. The S&P 500 has hovered near heights last seen in the late 1990s, and it spiked in 2021 when money was cheap. High price is not a timer, but it makes a market fragile. Small disappointments can become big drops. Limited upside if the climb slows, and heavy downside if anything snaps, is poor risk reward. There is a second force. Concentration. A quarter of the main index lives inside 4 names: Amazon, Microsoft, Nvidia, and Apple. Imagine a big table with only a few legs. It looks sleek, but one wobble and the plates slide. In the dot-com era, a handful of giants carried too much weight. Today it happens again with a new cast. When a few pricey stocks steer the whole index, stability depends on those legs holding firm. Valuation and concentration are not precise clocks. Markets can stay rich, leadership can stay narrow. Burry knows that. He does not need perfect timing to make a smart shift. He can reduce exposure where the risk-reward looks weak and look for places where it looks better. Which brings us to what he has been buying and how he has been protecting it. His new focus is clear. He tilted into Chinese technology leaders. In the third quarter, he lifted his stake in Alibaba by roughly 29% to around $21 million, doubled JD to about $20 million, and raised Baidu to about $13 million. Roughly $55 million concentrated in 3 platforms that touch e-commerce, search, advertising, logistics, and cloud. The bet is simple: low prices, large networks, and high operating leverage if demand returns. Why does China show up after years of gloomy headlines? Because cheap and disliked can be powerful once conditions change. The broad market trades near 10 times earnings, one of the lowest readings since the mid-1990s. Meanwhile, sentiment is cold after property stress and cautious consumers. If the tide turns even a little, the percentage move in earnings and multiples can be big because you start so low. What could push that turn? Policy is the first spark. The central bank cut the reserve ratio. There were rate moves and mortgage relief, and officials mapped a support effort. Cheaper loans and easier refinancing help builders finish projects, help companies roll debt, and help households feel less squeezed. When pressure eases, spending tends to return, and platforms that serve shoppers and advertisers can see profits ramp faster than sales. Income is the second spark. After a few flat years, disposable income has started to tick up from a low base, and projections show strong growth ahead. When a family replaces a fridge or upgrades a phone, that one decision touches factories, shippers, sellers, and digital marketplaces. Alibaba and JD are built to capture that flow. If enough families act together, earnings can rebound quickly because fixed costs and delivery networks already exist. Do not get it twisted. Burry is not blindly bullish on China. He hedged, his filings show put options on the same tickers he bought, insurance that pays when prices fall. In total, those hedges added up to roughly $43.6 million, covering large chunks of Alibaba, JD, and Baidu. He wanted upside if stimulus and income work, and cover if geopolitics or sentiment hit first. Why keep the umbrella open on a sunny day? Because clouds can form fast. Trade rules can shift in a headline. A single tariff or a limit on chips can move prices, even if daily business keeps running. And remember the economy. Property problems do not vanish in one quarter. Consumers do not flip from fear to joy in a week. So he pairs conviction with caution. That balance is the lesson for you. Now zoom out. Many investors are standing on a narrow beam. It looks shiny because the last few years were great. But a shiny beam can still be slippery. When one market is crowded and richly priced, and another is ignored and priced for gloom, money often rotates over time. Selling what worked and buying what lagged feels wrong, yet that is how big shifts usually start. Here is how to use this without copying a trade. First, filings are delayed. They show posture, not timing. Second, run a simple test. If your favourite stock fell 30% tomorrow, would you still want it? If not, you might be on the wrong table. Third, consider protection. Trim a position. Add a hedge when insurance is cheap. Add legs to your table so one wobble does not ruin dinner. So what did he actually do? He sold tens of millions of dollars in United States stocks while the music played. He rotated into Chinese tech, where prices are low and sentiment is cold. And he bought protection in case the sky darkens. Reduce where risk-reward is weak. Add where the crowd will not look. Protect yourself so you can survive long enough to be right. If you feel delayed, good. That feeling wakes you up. Look at your portfolio with a calm eye. Trim what only works as long as the party lasts. Add what you would be proud to hold through noise. Keep insurance when the price is fair. Sleep is an edge. Patience is an edge. Balance too. One last thought before you close this video. Big moves often look strange in the moment and obvious in hindsight. If nothing breaks, cautious voices will be mocked. If something snaps, those same voices will be called geniuses. Do not live at either extreme. Borrow the best part of Burry's playbook. Pair conviction with caution, and you will be ready when the next turn arrives again soon. The first step you can take right now is to subscribe to this channel. Here we'll be delving deeper into discussions related to this topic and the global economy in general, so subscribe to stay up to date on everything. And if you found this video valuable, like it so YouTube can share it with more people with your interests, and let me know what you think in the comments, and I'll see you soon. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.